Objective 2 in chapter 6. Objective 2 in our chapter. We're going to look at the inventory cost and contrast the goods flow from the costs flow and explain lower cost or market. So first, we're looking at our inventory cost. What goes into our inventory cost? It's going to be the price of the item that we're purchasing, less any purchase discount. It's going to be the cost of freight, any insurance, and any taxes. And depending upon whether we are the one that's purchasing it, FOB shipping or destination is going to depend on whether our inventory is going to include things that are in transit. Remember that FOB shipping point is included in the seller's cost of goods sold, and FOB destination point is included in the buyer's cost of goods sold. Okay? Did you need me to stay there, or are you guys good? Good. All right. So, again, I'm going to say that about, we are worried about the cost flows, not necessarily the goods flow. You may have situations where you're worried about the goods flow, which is the actual movement of the goods. But for the most part, we're going to be worrying about the cost flows. The goods flow is the physical, the cost flow is the money. Although cost is usually the most appropriate way to value inventory, at times inventory valuation may be reported below that on the balance sheet. And we talked about that like in chapter maybe 3, where if the value of the inventory has gone down because it's become maybe obsolete, or there's been some sort of physical deterioration in that product, and the value of the item from a market standpoint, the value of that item has gone below the cost, then you've got to take a loss on that at that time when you recognize that the value of the inventory is below what it cost. You write the value of the inventory down on the balance sheet, and you immediately basically expense the difference. So if you had something and you bought it at $100, and now you can't sell it at $100 or more, you can only sell it at, say, $80. You've got to take that value of that item and basically that $20 and basically expense that $20 difference as a loss. And you'll see it. Some of you, I've seen it on your financial statements. You'll see something like, loss on value of inventory, or, operating loss, or some item that they're stating in their on their income statement because of maybe an inventory valuation change. And that's basically the lower of cost or market rule. So it's when the replacement cost of inventory falls below the historical cost, the inventory is written down to the lower cost, and a loss is recognized and recorded on the income statement. That's the lower of cost or market rule. It's applying what principle? What principle? No. Well, you do end up applying the matching because you're now taking the loss in the accounting period where you recognize it. Yes. Conservatism. Very good. Conservatism. This is applying the conservatism principle. Is it likely that if the value has gone down that much, is it likely that it's going to go back up? No, of course not. No, it's not. It's not going to go back up. So if it's not going to go back up, there's no chance that you're going to, or virtually no chance that you're going to take a gain on that or be able to sell it for more or have a profit on it. So you've got to recognize that loss immediately. So it is applying the example of conservatism. Yes, Tyler.
The company has 2 million shirts or something, and then they put it on clearance or whatever. That
exactly.
Is that a loss? So?
Correct. It depends. It may not be a loss. Just because it's in clearance doesn't yet mean it's a loss, because they could sell it at their cost. Okay, so again, you bought it at $100. I bought it at $100. I really want to sell it for $120. I could put it on clearance at $105 and I'm still squeaking a little teeny tiny bit of gross margin out of it. Doesn't mean I'm covering my operating costs with it, okay? But I'm still squeaking a little bit of gross margin at it. It's when I can't even sell it for $100. That's when I'm doing this, okay? I can't even, I'm buying replacement stuff at lower than that $100, okay? And it must be reported on the financial statements. Inventory is written down, and it can be done in one of two methods. An item-by-item method, I'm not going to make you guys do this calculations right now. Major category method. So item-by-item is understandable. You know, it's a specific item. And then categories, you're just taking a gigantic category of things and you're writing them down. Yes?
What if, like, stock goes down?
Your stock of your company goes down?
Would you have to take an expense for that?
No. Because realize, okay, let me pause this for a second. Their stock doesn't affect anything on the write-down stuff. Okay, so that's category objective 2. Let's start going into the pricing of the inventory under the different methods. So we're going to calculate inventory costs under the periodic method using the various different 4 costing methods that I talked about. And what I'm going to tell you right now is you need to have your textbook open to this chapter while we're going through this. And what I want you to do is have your textbook open to page 300. Well, actually, first start with page 299. So please open your textbook up to page 299. Okay. So, we're going to talk about pricing ending inventory results from 2 measurements. Basically, we're going to look at it both in terms of the quantity and the cost. Okay? The quantity of the goods, like we talked about 10 tables, and we're going to talk about the price of those 10 tables. Okay? And we're going to look at it under periodic cost. Periodic system is going to be determined based on a physical count, like we talked about in Chapter 5. And we're going to look first at the periodic system, using the actual physical count, if you will. So management is going to make assumptions about cost flows and use one of 4 different methods to talk about the cost flows. They're going to use either the specific identification method, the average cost method, the FIFO method, which is just first in, first out, or the last in, LIFO method, last in, first out method. And as we go through these notes, I'm going to make references to the information in your textbook. And the reason I want you to look at it is because I need you to cognitively process it in your own individual brains what the numbers implications are, okay? Let's look at, we're going to use this, all of these are going to use the same inventory data. Oh, sure, sorry. Okay? Okay. We're going to use all of the same data. This is the same data that is in your textbook on page 300. And so what we're looking at here is that this is our inventory. So where is this? Inventory is balance sheet data. Okay. This is our inventory data as of April 30th. And what we're showing is that on April 1st, we had 160 units in our inventory, and those 160 units were valued at $10 per unit for a total cost of $1,600. Then on April 6th, we purchased 440 units at $12.50 to give us a cost of $5,500. And then on the 25th, 400 more units at $14 per unit, $5,600. So this is just basically showing you how those same items, like those same shirts like George has, different days, it's going to cost different amounts from the vendor. Just like you going to the gas station and the gas costs a different price on a daily basis. You go into the grocery store and there's maybe slightly different price for strawberries today versus yesterday. Okay? Same type of thing for a business. All right? Then it's showing me I'm adding up my 160, 440, and 400 units to show that I have units of 1,000 total goods available for sale. And the value of those 1,000 units is $12,700. My challenge is, you remember that other page where I showed you I have my goods available for sale? My challenge is to figure out how much of those goods falls into ending inventory and how much of those goods falls in cost of goods sold. So I've got to try to figure those two things out. So I'm going to look at my units available for sale. I know that I sold 560 units. So that means if I sold 560 units, that means that the number of units I have in my ending inventory is 440 units. But of that 440 units, what's the value of them? See my dilemma? Do you understand what I'm saying? Do you understand? Like, I've got 440 units. How do I know which of these 560 of this total 1,000, what of those 560? Did I sell all 160? Did I sell 400 of these and 40 of these? We don't know. Do we care? Do we care?
Yeah.
Why do we care? They're different prices. So what does that mean if they're different prices? Right, different profit margins. Exactly. I might be putting all of these on, I might be selling all of these for $20 a shirt. Let's say they're shirts. $20 a shirt. Right? Did I make a different profit on these 160 that were at $10 versus these 400 that were at $14? Absolutely. It's totally different profit margin. Does it affect my gross profit? Absolutely. Does it affect the value that I place on my ending inventory? Absolutely. So, like, you guys don't even ever even think about it. But so then that's why when I say to you guys, my gross profit changed, you got to understand what was changed. Because I could sell the exact same number of things, but depending upon which of these things I sold totally affects my profitability and my balance sheet value. Okay? And so that's, as a business owner and a manager and an analyzer, those are the things that you have to understand. Okay? So now, what we're going to do is we're going to use those 4 different methods that we just talked about, the specific identification, the first in, first out, the last in, first out, and the average cost method we're going to make assumptions. Are the assumptions necessarily correct? No. They're just assumptions. It's like anything else. As long as I apply that assumption consistently, it's okay. It's where if I change the assumption, like one day I use LIFO and one day I use average cost, that's where I run into problems. Okay? But if I apply a consistent approach to my business time in and time out, then I can basically, utilize that and apply my conservatism, consistency, comparability principles. Okay? But for most businesses, you're not going to know exactly specifically which shirt or which jacket or which hat or which whatever you actually sold. There are some businesses where you will. Okay? Boeing. Boeing makes an aircraft. They know exactly and specifically which aircraft they're selling. Okay? They have to. Okay? A car manufacturer. They're going to know exactly and specifically what car. They track each car by VIN number. So there are some companies that only use the specific identification method because they have specific specifications associated with each sale. Okay, but for the most part, does Dick's really care whether they sold the shirt that they paid for on April 1st? They only care from the standpoint that it affects their profit margins. They understand that. That's it. They don't care otherwise. Yes.
So say, like, obviously Nike doesn't care about like an individual shirt, but what if they were like monogramming or like personalizing? Then would they know specifically which one?
Yes. Yes. But they wouldn't know the specific shirt, but they'd add on a fee associated with that monogramming. So that part they would track. Yeah. Or if they did only custom orders, then it would be a specific identification method.
Okay.
If it's all custom orders, basically cars are, pretty much, somewhat custom, different features in them and so on and so forth. Right, right. Okay, so that's what we're going to be doing. We're going to be using the same data, and we're going to see how using the same data, but using different methods of valuation, are going to affect our income statement and balance sheet. So, let's look first at the specific identification method. Because in the specific identification method, it identifies the cost of each item in the ending inventory, and they apply this to the specific items for cost of goods sold and ending inventory. So it will tell us specifically which items we sold and which items we kept on our books. All right? So we're going to look at, if we will, on page 300. We're going to look at specific identification method, and it identifies that here we've got those different dollar amounts, and it's going to say here, identify the cost of each item in ending inventory. So I'm reading literally from page 300. Okay, look at where I'm reading, the middle of the page 300. And it's giving me that it can only be used when possible to identify the ending inventory as specific items. For instance, on April 30th, the ending inventory consisted of, so it's telling me what was in my ending inventory. Ryan, what are you doing, McGrath? Please stop. April 30th, my ending inventory consisted of 100 units from the April 1st inventory. So you can see up there on the chart in here, it's showing 100 units at $10 per unit because my April 1st inventory was at $10. Okay? Then it's saying I've got 200 units from the April 6th purchase. So 200 of those items that were valued at $12.50 are in my ending inventory. And then it's saying 140 units were from the April 25th purchase. So again, we're using this data here. So it's telling me I have 100 units from this April 1st. I have 200 units from April 6th. And I have 140 units from April 25th. Okay? And so I take those unit quantities and the dollar amount, and that's how I'm figuring out, that's how I'm figuring out what the units of my costs were. So, and again, this is telling me that I'm looking to calculate what the value is of my ending inventory, okay? So it's saying I had 440 units in my ending inventory. Each unit was at the different values for a total cost of $5,460. So that goes into my ending inventory. And if you remember, it said my cost of goods available for sale was $12,700. So I'm taking the 5,460 and subtracting it and getting my cost of goods sold. So these two numbers are the flip of each other. Okay? If I can calculate my cost of goods sold, I can figure out what my ending inventory is. If I can calculate my ending inventory, I can figure out my cost of goods sold. Okay? Like our algebraic stuff, right? If I've got two of the variables, I can figure out the third. All right. Same thing here. It's saying basically items left in inventory are matched with the original invoices. In this method, it's usually primarily for high-priced items, cars, jewelry, expensive stuff that you can more easily flag or track, I should say. And if it's definitely difficult if you're doing large volumes of things. Oh, am I going too fast? Good? Okay. Now let's look at the average cost method. Again, keep that same data open at the top of page 300. And we're going to use the average cost method, which is basically a weighted average method. And we're going to value our inventory and our cost of goods sold based on the average of the costs of the items available for sale. So we use this formula. This method tends to level out the effects of cost increases and decreases. That's something you should keep in mind. Just like any other average, you're kind of bringing it to the middle, okay? So it tends to smooth out the valuation changes. So I'm going to take my, basically my goods available for sale, what was the number for my goods available for sale? Look at your data. What was it? 12,700, and then how many units were available for sale? 1,000. So I'm going to take the goods cost available for sale divided by the units and get an average, right? And that's going to be my average unit cost. Then what I'm going to do is I'm going to apply that to the how many units are in my ending inventory. My ending inventory units doesn't change depending on which method I use. My units are still the same number. It's figuring out the valuation that's changing. So I'm going to take my units and I'm multiplying it by that factor. So I've got my units available for sale divided by my units that were available for sale, gives me a factor, and I multiply that factor times the ending inventory, gives me my ending inventory value, and again, I plug it into this same formula. Cost of goods available for sale minus ending inventory gives me my cost of goods sold. Okay, how many units did we have total that we sold or that were available for sale? How many? 1,000, right? Okay, so if I had 1,000, I could do the flip side. Okay, so we have, our formula is always this. Our formula is always COGAS, cost of goods available for sale, minus our ending inventory gives us our cost of goods sold. That's always our formula. If I have 1,000 units and I had 440? 440, how many did I sell? 560. Can't I do this if I was doing this? I said 12,700, right? 12,700. Now let's say I didn't know this. Okay? Using the average method, couldn't I do, what is the number there, 12, what? 70? Couldn't I do 560 times 1270 gives me, what's my mathematical number? What? Okay. 7,112, and then solve for this, right? I could do that, right? And then I would go, 12,700 minus x equals 7,112, right? Solve for x, right? Just get this over here. And then what do you get?
4,800.
It's going to be that same number as we have up there. 5,088, right? So I'm just trying to show you that you could do it either way, okay? You could just do the flip of it, is what I'm trying to show you. You're going to get the same answer, Okay? Alright. Then we have the first in, first out method. Again, we have our same numbers here. 440 units were sold. I'm going to stop. Because I'm going to rush it and I don't want to do that. Okay.